Cool. So we'll kick it off. We're at about 20 participants. People start trickling in. So we have John Miller. I mean, needs no introduction. Everyone, most people have heard of him. Great guy. He's here today to answer questions. We were thinking LLCs, but obviously very knowledgeable on, the taxes and entity formation. So whatever, we thought this is our first meeting for the month, and we use a Q&A. So we wanted to bring John in here to help you guys out. So with that, John, maybe not everyone knows you, so maybe you can give us a quick little intro of who you are, and then we'll open it up.
Sounds good. Do you want me to talk a little bit about LLCs first, or just open it up to questions there, Luis?
Yeah, I think maybe just a little bit of a background about you, so those who don't know you can understand, and then we'll open it up.
Sounds good. So as I know some of you, I'm John Miller, but for those of you that don't know me, I'm a CPA and started my career in Los Angeles. I have a master's degree in taxation. Totally boring subject for most people, but it's made a living for me and my family. And we have a practice that really spans the United States. And we also have clients in Sweden, Canada, and South Korea. I think a couple other countries, Mexico. And largely those are U.S. citizens that live abroad or have businesses or real estate ownership in the United States. I was with PricewaterhouseCoopers, or now PwC, and left as a director, which is a pretty high level position within PwC. I was responsible in the end, even though I was in the tax area, I was responsible for all of the business development in the Pacific Northwest, which covered Alaska, Washington, Oregon, Idaho, Utah, and was responsible for driving the tax practice revenue for that area of our firm. And then I had the opportunity to go out and be an entrepreneur. I had some venture capitalists approach me and ran a couple of technology companies. And then with the total great recession of 2008, I started back in and built my own practice this time, using all of the things that we used to sell to really high net worth individuals and very large corporations in the way of tax planning, only we wanted to do it more in a small firm environment. So we have about 15 people in our practice, and we are now up to, we physically have people in Utah, Idaho, and the Philippines now. And so we're growing, and I'm negotiating now on a New Jersey practice location. So we're growing extremely fast. And we work primarily with business owners, entrepreneurs, high net worth families, and helping them to solve the tax problems that seem to just keep surfacing, especially with a lot of the tax legislation that's going on in Congress. So we help a lot of individuals who have, as I said, businesses. We help a lot of individuals that have stock options. So there's a huge amount of tax planning that we do around stock options, restricted stock units, and other complex compensation arrangements for tech executives. So that's something about me. I do a lot of business planning, entity planning, setting up and structuring LLCs, S corporations, C corporations, partnerships for all kinds of different reasons. So that's a little about me.
Yeah, thank you, John. We appreciate it. Maybe if you can just, so in this CEO that we have people who just started a business, people who've been doing this for quite some time, making millions of dollars. So maybe if you can kind of just give us a little bit of a background about, just start with LLCs and kind of why it makes sense. And then if someone already has an entity and it's not an LLC, does it make sense to convert?
Yeah, great question. So as I talked about at Driven about a week and a half ago, I can make a business case for every type of entity. The absolute Ferrari of entities, in my opinion, is the limited liability company because it has a lot of flexibility. So I'm just going to step back and talk about entities in general. There are liability limiting entities. This would be primarily a corporation or a limited liability company. And then there's the unlimited liability companies. These are companies that can pierce the company and go to the ownership, and the owners can be liable for the acts and omissions and torts and errors of the company. And so that would be partners or partnerships and proprietorships. Limited liability company is kind of a newer entity in the United States, newer in that, they started emerging a lot around 30 years ago. And so the tax code wasn't necessarily structured for LLCs. We had some check the box regulations, which are regulations is kind of law. And what it is more of the opinion of the United States Treasury on what an entity should be. And for a while, it was really complex. Then they came out with these check the box regulations, and it allows you to choose as an LLC to be taxed like a corporation, or a regular corporation, a C corporation, or an S corporation, or even a partnership, or what we call a disregarded entity. The cool thing about an LLC is you can use it to hold cars, you can use it to hold real estate, you can use it to operate your business out of. It could not be a business. Like you could stick your house in an LLC as the owner and just have a non-taxable or a disregarded entity. So it has a lot of flexibility. But with a business owner, typically what we like to do, and when I say business owner, I'm not talking about like rental property. I'm talking about active business where maybe you're selling real estate or you're a property manager or something else. So we typically set up or establish the LLC, the limited liability company, and then oftentimes for tax motivating purposes, we'll make an election that elects it to be taxed as a corporation and then specifically to be taxed as an S corporation. An S corporation gets its name from subchapter S of the Internal Revenue Code. A lot of people think it's because it's a small corporation, and sometimes they are, but sometimes they look like very, very large entities. But the primary strategy behind an S corporation is to save on what we call self-employment or payroll taxes for the ownership group. So if you're a realtor, let's say, we have a lot of realtors that or loan officers that do business in this manner. They get paid. They direct those funds to the S corporation. They have to be on payroll. But the difference between that and being a proprietorship is, as a proprietorship, all of that money comes in and it's taxed for self-employment taxes at 15.3%. Whereas if we put it in an S corporation, we can carve up some of the income into reasonable wages and the rest as net income. And the only portion that's subject to payroll taxes is the reasonable the reasonable compensation. The other strategy behind an S corporation is that it's only taxed once, whereas a C corporation, it's taxed at the entity level. So if the entity has $100,000 of income, it might pay $21,000 in taxes. Then it has $89,000 to distribute out to the owner in the form of a dividend. And then it's going to be taxed at another, right now, 20%, but they're talking about it going up. So it's taxed twice. Whereas with an S corporation, the earnings, this part that's not reasonable compensation, that's all going to come out as income to the owner, whether they pay it out or not. And it's only going to be taxed once. So the primary strategy for a business owner is, that limited liability, and then they elect S corporation status. They limit the taxes to only one level, and then they limit their payroll taxes. So we see sometimes huge amounts of tax savings just by structuring it in that manner. I want to mention too, on the LLC, the other reason why I like that better than a corporation, although corporations sometimes are necessary, but the primary reason is in one of the, actually in several of the states, the reason for putting the LLC together is it limits you from the liability of the company. So let's say your employee goes out to pick up office supplies at Staples, comes back, gets in a car accident in a unlimited liability company of some sort, like a partnership or a proprietorship, you, the owner, are now liable. But with an LLC, as long as you're not engaged in gross negligence and you're treating it like a business, you're doing all the right things, the liability will be limited only to the company's assets. You won't place your personal assets at risk. Well, that's great because you're protected from the liability of the company. But then in the state of Wyoming, we have what we call charging order protection. And that's like a super liability limiting opportunity, because while you protect yourself from the liability of the company, what's to protect the company from your liability? So now in the same situation, instead of my employee getting in an accident, let's say my son, who's a teenager driver, he gets in an accident. Now the attorneys come after me, but they also come after my business. And the advantage of being in a state like Wyoming is the best they can do is hit you with a charging order to the LLC. And all they can do is say, we want any money if any money comes out. But if no money comes out, then the statute of limitations for collections will run out, and then that liability drops away. Whereas if that LLC is domiciled in another state that doesn't have charging order protection, they can actually, in some cases, liquidate the LLC, and all the assets now are, in favor of the individual suing you. So the great part about LLCs is if you put it in the right state, like Wyoming, you get protection for the LLC from you. And in most cases, in all states, you get protection from the LLC as an individual. So LLCs are the absolute Ferrari for asset protection, in my opinion. And then if you dovetail that with the tax planning, there's some really cool things you can do. Now, as I said, there are some reasons for having corporations. Like, for example, an S corporation cannot deduct fringe benefits, like health insurance, but we have a workaround for health insurance, like parking, like, other fringe benefits that employees get to partake of. If you have 2% ownership in an S corporation, or for that matter, in a partnership, then you don't get those fringe benefits. Whereas in a C corporation, you do. And sometimes people say, well, why would somebody operate in a C corporation? And I would tell them this: sometimes if we're funding, say, a venture capital funded entity that's going to go public someday, we probably need to be a C corporation, take the tax hit. There's other ways we can plan around taxes, or like fringe benefits. We can deduct fringe benefits, like maybe messing around with the payroll a little bit, paying the key executives more money, and bring down the tax liability for the C corporation. But there are some tax planning opportunities for C corporations that aren't available in S corporations. Now, LLCs are also really good for holding real estate or assets like investments and things that generate passive income. So passive income is like rents, dividends, interest, those types of things. And we don't want those assets in an S corporation. But if we have them in an LLC, then now it's a disregarded entity that either the income comes to us, or if we have more than one owner, it'll be a partnership. So we'll still have the limiting liability, but we'll have to do something different because we don't want passive assets too often in an S corporation. There's too many things that go wrong. For example, with real estate, a lot of times if you ever have to refinance the real estate, you have to distribute it out of the LLC, refinance it in a personal name, and then put it back in. And that actually creates a taxable event if it's set up as an S corporation. Whereas if it's a partnership or a proprietorship, it's just a change of identity and you don't have a taxable event. And there are actually provisions for that. So there's a business case for each one of these types of entities. But I think the great first start is set up the LLC at the state level. If you want super liability protection, look at Wyoming. If you're in California and you set it up in Wyoming, you'll have to get a non-resident, LLC approved for California, but the state of domicile still protects you with that charging order protection. And then sit down with somebody like me or your CPA or someone and say, now what's the best tax planning opportunities with this LLC? Should we choose to be an S corporation or a C corporation or a partnership? What should we do? And I think a big driver is it an active business, or do you have passive income producing assets that need to be in something other than an S corporation? That's a lot, guys. I'm sorry. I probably went on for 10 minutes and I apologize. So let's throw it up for some questions and see where we go.
Yeah, thank you for that, John. Very informative. Let's see, I see a couple of hands. Jimmy, you're the first one again, so let me unmute you.
And Juan Herrera is stretching, but he's kind of like raising his hand. But all right, Jimmy. Who's Jimmy? I can't see him.
Yeah.
He's there somewhere.
Yeah, I see him for some reason. I don't have that button anymore.
Oh, I see him. He's in the upper left now for me.
Can you guys hear me?
Yep.
Oh, yeah, you can. Okay.
Okay, cool. John, can you explain, I guess, the deadline for tax loss harvesting, like for stocks and stuff like that? And can you go a little bit into detail the things that we should know?
Yeah, perfect question. And not related to LLCs, but a great question, regardless of who owns the stock. So what tax harvesting is where, let's say you've taken some income or you got some gains and you want to offset some of those capital gains with some positions that you have where you're underwater. So let's say you bought Apple at I don't even know what Apple's priced at today, but let's say you bought XYZ stock at 100. Now it's worth 70. You know, if you sold it before the end of the year and the trade cleared, then you'd have a $30 capital loss. And you can use a capital loss up to $3,000 in addition to offsetting all your capital gains. So let's say you had $100,000 of capital gains. You could harvest $103,000 of capital losses if you had that in your portfolio. Now, there is one trick, though, and that's called the wash sale. So if you buy it back, now there's some disagreement as the timing, but let's say it's within 30 days. Okay. I would go 35 days just to be safe because, and I'll just tell you, the Schwabs, the E-Trades, the investment advisors, somehow, some way, these guys screw it up sometimes. I had a lady that came to me this year and she thought she harvested at $1.5 million in tax losses, and she bought it back, and the wash sale rules apply. And what that says is you don't get to count the losses. They retroactively go back and say no loss for you. And so now she had a massive tax liability, and there was nothing we could do for her. It's all in cement, it's concrete, it's done. So key is if you want to take some losses to offset capital gains or take advantage of the up to $3,000 capital loss rule, sell before year end, make sure it clears before year end. So it doesn't mean just putting the order in, it has to clear. So I'd make sure you get that market order in, and then don't buy it back for say 35 days and you'll be fine.
Thank you.
And you can buy it back. But here's another thing you might do. You might buy something else that's so maybe it's another text, you sell one tech stock, let's say you sell Zoom and you're at a loss and you want to buy something else. There's some stuff in that space that still shows similar growth factors. I would look at buying something else, but if you're going to buy that same stock back, give it some time to gel. Minimum, I'd say about 35 days. 30 will work, but I'm telling you, people screw it up all the time. So
yeah, and I think that's great, John. That's something we talk about in the Wealth Lab as well. We use an example, a real life example that we did with our clients with Baba. So a lot of the Chinese companies have taken quite a bit of a hit. So we were able to really generate those tax loss harvest for our clients. And what we did is we bought an emerging market ETF that correlates rather highly with Baba, waited the time period. And then just like you, we played safe. We gave ourselves a buffer before we went in and unwind.
Yep. Perfect strategy. Just a buffer of a few days, is all it takes. And guys, I've been doing this long enough. I've seen everything messed up, it seems like. And just when I say everything, somebody walks into my office with something new. But, always give yourself a buffer.
Yeah. And then Miko, I see your hand. So
I'm looking for Nico. Oh, there's Miko.
Hey, how's it going, Luis? How's it going, John? Thanks for making the time to be here, John. I'm from Canada, so I wanted to ask, What would be the equivalent to an LLC here in Canada?
Oh, that's a great question. Gosh, I just did one of these down in one of the South American countries. Honestly, what I do is I consult with the attorneys. It's not the corporation, but it is a liability limiting company. And I don't remember what it is for Canada. I apologize. If you want to call me on another day, we can look at it. And all the tax stuff is going to be different for Canada as well. So, but I will say this, most countries like Australia and Canada do have what we call pass-through entities. A pass-through entity is a partnership, an S corporation, where it's not taxed. All of the income from that pass-through entity goes through to the owners. That's what I would be looking at, is what are the pass-through entities available for Canada? And I apologize, I'm not a Canadian tax expert. I have Canadian clients, but I'm doing their US stuff, not their Canadian stuff. We usually partner with somebody in Canada. So
cool. No problem. Thanks, John.
Are you a US citizen? I might just ask that though.
No, I'm
you're
Canada. Yeah, I'm Canadian.
Good. Yeah, because I have had some problems with Canadians because you have your retirement plan and there's some financial reporting obligations to the United States Treasury that most US citizens living in Canada miss. So it's a scary thing when it happens. Okay.
Cool.
Thank you, Miko. And then Mauro, you're up next.
Yes, I know you miss me.
Who is this?
He's over here.
Hello. I know you miss me, so thank you, everyone. John, question. When we are overpaying taxes, right? So we're constantly overpaying taxes. I did it before to qualify for larger, for higher financing.
Oh, there it is. I've met Marco.
So,
Marco.
Yeah, I know. Mauro.
Yeah.
That's me.
Yeah, there you go.
So I overpaid taxes. I know I could have, I had plenty of write-offs, right? I overpaid taxes plenty of times because that would help me qualify for higher. And with all these events, I know we're all learning and going through a lot of these events. I've done refinances and purchases and about talking real estate. So I buy, I sell. Well, I haven't sold much. I buy, I refinance, do constant. And I think this question would apply to a lot of us, right?
Okay.
You know, beautiful minds like yours, you understand the process, what goes where. In all reality, we don't. Most of our accountants, I guarantee they don't keep track of it. So I know I am overpaying as a fact. And there's a saying that says that as long as you're paying the Fed, they don't care. How careful would you be? How much more careful would you be with all these transactions? I know it's super hard with our lifestyles, right? And who keeps track of it? To be honest, I mean, I find myself overpaying, yes, and that's okay. I'm okay with that. Things are working out, and but obviously you don't want to keep doing this for many years. And how many years back can they go and say, you know what, I owe you money. The Fed, I owe you money, right? Like they owe us money. I don't know.
Let's talk about statutes of limitations. There are 3 statutes. One's the ACED. That's the assessment statutory end date. That's how far in the future can they assess. Another is the collection statutory end date. CSED is what we call it. That's how long they can collect a tax debt. Okay. And then the third one is the refund statutory end date. The RSED is how I refer to it. I guarantee you 99% of the accountants out there don't know this because sometimes when they call me, okay, I'm the guy that fixes their messes. Okay. So the ACED statute works like this. If it's fraud, it's an unlimited statute. Okay. So if you're engaging in fraud, they can go back 50 years. The practical reality is they're not unless you're a celebrity or a criminal or, you know, if you're just mom and pop, they don't have the resources nor the will to go after you usually unless they got you on something else. You know, you're Al Capone, they want to get you on tax fraud. Okay. And it's hard. Okay. Then there's a substantial understatement of income. And I think it's 25%. So if you've understated your gross income, okay, and it's gross, it's not taxable income, it's not your AGI adjusted gross income, and that's where a lot of even IRS employees get it wrong. It's actually gross income. So let's say I make $100,000 and I omit a $30,000 distribution from my IRA. The IRS has 6 years from the later of the filing date or, well, actually the extension date or the filing date, whichever years later. So if you file late, like let's say you file a 1990 return in 2021, 2021, the 6-year statute starts from 2021. And that's only for substantial understatement. And even on substantial understatement, when I've been in examinations, that was what you would call an audit. They don't typically go back 6 years. They just don't see it happening very often. And then for most people, it's 3 years. They can go back and audit you. Okay. And it's 3 years from the date of filing or the date of the deadline, including extension. So if you extend October 15th, it's October 15th. If you file in November and you file late, it goes 3 years from November, that forward. Okay. And sometimes in an exam, it's very common to extend the statute. So we're at 2.5 years and they say, hey, this is going to take a year for us to audit, somewhere between 6 months and 1 month to the statute close. They'll customarily and as a courtesy ask to extend the audit for a year. I don't have a problem with that unless I have what I call an eggshell audit, like we've got some major issue in there. And then I might say, guys, you've had plenty of time. Let's see if we can wrap this up. And I'll do some things to try and wrap it out without extending the deadline, the collection deadline. So that's the ASED statute, the assessment statute deadline. Then the collection statute runs from the date of assessment. And assessment happens usually about 10 days after you file, somewhere in that time frame. And it's because assessment is a formal process by the IRS. It's the bookkeeping entry that says, at least for now, we agree that you owe this money. Okay. That's when it starts to run for collections. And that's 10 years plus what we call tolling events. And tolling events are events that extend the statute to longer than 10 years. So you file an offer in compromise, it extends the statute. You file an installment agreement, it extends the statute. So there are ways to extend the statute. At the end of 10 years, most of the time, the debt just drops away, but the IRS can go into district court, get a judgment against you, and now the statute is unlimited. For practical realities, I rarely see them doing this except in the case of bad actors. Now, the RSED statute, that's probably the one you guys are most interested in. So that's the refund statute. Let's say your tax return was just functionally done wrong. Somebody missed something. We can go back 3 years and get a refund. I don't have a problem doing that. I'd file them, but I'll tell you this, the first amended return, you're probably okay on unless it's a big issue, big amount or big issue, then it might get examined or audited. Or second amendment, because we have had to amend a return twice. A lot of times I'd say you're running the audit risk. They're going to come in and audit or examine it. And I will say this, records are king on audits. I had a guy that had really poor accounting, really poor records, and they came in and audited him and they assessed him $31 million. No lie. And we fought it. And for 2 of the years, I don't remember what the 2 years, they involved double-digit millions, I think. Or no, I think it was about 9 million for the first 2 years. And we settled at $10,000 owing. We were rock stars on that one. But I'll just say this, it's better not to get yourself in an audit if you can avoid it. But at the end of the day, audits is just like the lottery. Every once in a while, somebody's going to win. I would just not make it easy for them. So when we prepare tax returns, we prepare the return, but then we look over it and we say, is there anything that would tip the IRS off that we ought to, work with a little bit? Like if their rent's really high, maybe we split it out and we say, okay, some of this is equipment rental and some of this is real estate rental, or mileage. I've seen people get audited because they had 36,000 miles reported on a tax return. Now, I don't mean to, belittle this point, and I don't mean to make anybody feel bad if I'm picking on somebody, but let me get this straight. You drove around your car all year long and you magically stopped on 36,000 even miles. The IRS is not stupid. They know somebody just pulled a number out of the air and put 36,000 miles on. So even if legitimately your log or your app says you drove 36,000 even miles, I might trim it back and suggest to you, hey, why don't we just put in, instead of 36,000 miles, let's put in $35,897 or something. And then we leave a little change on the table because I don't want to tip the IRS off to a possible problem in the return. But I also don't have a problem taking legitimate deductions. So I've had some people go, well, I just feel like I had too much. And I'm like, what's too much? If you incurred it, let's claim it. Who cares? Because under exam, if it's a legitimate expense, we should take it and we'll get it. Now, another point to you, Marco, is I have gone into an audit where somebody didn't claim everything, and we actually presented that, and they gave us the additional dollars without even doing an amended return. So it actually helped us. So, but I would argue take every deduction you can, make sure you can support it with good accounting, clean accounting, and receipts when needed, and you'll be fine. But don't leave money on the table. Take it if you can. That's a long answer. Sorry.
That was great. And Omar, I see you're up next. Go ahead.
Where's Omar?
Hey, John, how's it going?
Good. Good to see you again.
Likewise. Quick question. So once you establish your LLC, how far can you go back when it comes to startup costs? And like, what is a good rule of thumb to keep in mind?
Startup costs?
Yeah.
Okay. Great question. So on startup costs, it doesn't matter when you incurred the startup costs. Okay. They're what we call capitalized. But it relates to the trade or business to which you're starting. So let's say you're going to start an automotive business, but you incurred some startup costs for, real estate. That really doesn't count. But the startup, here's the way startup costs work. Any expense prior to establishing the trade or business. And that's a court-tested, judicial doctrine. They look at when was the trade or business established. And there are tons of court cases on this. I had a lady come to me and she took $150,000 of real estate classes. Okay. And she wanted to deduct those on her return. And I said, but you didn't even buy real estate in that year. So you didn't establish your trade or business. And she goes, well, my attorney said I could deduct it. I said, good luck with that. And I said, here's a court case that you need to take to your attorney. It was just tried in this circuit, and it is your fact pattern exactly. The only difference is the amounts and the names. You are all over this. You will lose that case. So the key is try and establish your trade or business as quickly as possible. If you're renting real estate, put that for rent sign out, start trying, I know we don't use signs much anymore. Advertise it on the internet, really try and get a tenant. Okay. If you are, opening a restaurant, open up on the patio if you can, do whatever, because as soon as trade or business is established, it's no longer a startup expense. So the rule with startup expenses is you can't deduct them. You can deduct a certain amount, but then after that, you have to capitalize them and amortize it over 60 months. So you recover it over 60 months. So what I tell people is as soon as possible, get your business started. So when I started Private Tax Solutions, I think I told everybody at Driven, I intentionally did it with $100. It didn't have $100 in it very long, but I did it because I wanted to show you could bootstrap a company. But I started the business immediately. So I think my only startup expense, which I was able to deduct, was my filing fees for the LLC and a couple other miscellaneous things. And I was able to deduct those. Does that answer your question, Omar?
Yeah. So for example, like the Driven events, I've been going to them for like 2 to 3 years now. Mm-hmm. I can take all that and deduct it whenever I start my business, right?
Yeah, as long as you're under the amount. Yeah, and all of a sudden, guys, I haven't had lunch, so I can't remember the amount. But once you're over the amount, you have to amortize it and deduct it ratably over 60 months. Okay. But yeah, I'd use it for your business. Absolutely. As a startup cost. Yeah. We also have organization fees, which actually I misspoke when I said the filing fee for the LLC. It's actually an organization expense. So same category. You can deduct them up to a certain amount. You go over the amount. Now you have to amortize them over 60 months.
So we have 2 questions left, 8 minutes before we conclude. So we'll go pretty fast. Jerry, you're up.
Hey, what's up, everyone? What's up, Luis? Thank you for your time, guys. Hi, John. So I have
Jerry.
I have a single member LLC. I'm in the mortgage business, so I get 1099. right? My
is the
fiance,
1099 to you or is it to your
it's
LLC?
to myself. To myself.
Yeah, we need to fix that. But okay.
Right. Well,
and I know California is tough. Yeah.
My understanding is until I'm a broker, I can't get paid to a corporation, right? I have to get paid to my name, and my credit union allows me, since I'm a sole member LLC, or since I'm a owner of the LLC, to deposit a check that's made payable to myself. So my question is this: my fiance, she went from W-2 to 1099 as well a few months ago, and is now being paid to her name. Can she join my LLC and be paid to it, or should she set up her own?
Either way, kind of depends on you guys and what your
and also
are.
with payroll, if you can kind of elaborate a little bit more.
Yeah. Okay. Can I go back because there's a bigger issue you haven't addressed on the table? Okay. And I have a question. Is your LLC an S corporation? Or
yes.
Is it just an LLC?
An S corp.
So a huge audit issue right now is, and I just closed one up, is if the 1099 is issued in your name, it's not the LLC's income, it's your income. So now you have a Schedule C business, not an S corporation. That's a problem. Now, in this case, in the audit, here's how we settled it. I don't know who had the brilliance to do this, and it has not been time tested in the courts, but I don't think the IRS wants to test it. But they did a management agreement between the proprietorship, the Schedule C business, and the S Corp. So the 1099 has to be reported on your Schedule C. The stupidity is the CPA that prepared this return just basically put reported on EIN this and listed the S corporation. That does not work. It fundamentally does not work. What you would want to do is you'd want to show all the income on your Schedule C, have a few expenses on that Schedule C, and then say management fees to this S corporation. And then on the S corp, bring in all the management fees. Okay. That way you get the benefit of what the S corp is intending to do, which is probably for you, the biggest thing is to limit your payroll taxes. So then you need to set up a payroll service. You actually have to pay yourself. You have to withhold taxes. You get a paycheck. We do it, and it's direct deposited in your bank account. And you can't just pay yourself some arbitrary amount. You have to pay yourself a reasonable wage. That's what it would cost to hire someone like you to replace you. So I've got realtors making $800,000 a year in gross commission income. Actually, some that are making over $1 million a year in gross commission income. And we calculate the reasonable wage for them using a service we call RC reports. And most realtors end up somewhere around $48,000 to $60,000 in reasonable wage, because the average realtor in this country makes less than $30,000 a year. And so we can justify that. We produce the report, and we've gone through audits successfully. But in this one case, the guy failed, except I came back and said, I somehow have a management agreement. And look, the date on this is clear back when. And we didn't backdate anything. He actually legitimately had this management agreement. So I said, so the S Corp survives and so does the Schedule C, but the Schedule C business gets to deduct the management fee, and the IRS went with it. So there's a slight issue when the 1099 is issued in your name. You're going to need to report it on Schedule C, and you're going to need a management agreement between you and the S Corp. And then I would move towards being a broker so that you can direct the 1099 payment to your S Corp. And actually, they won't issue a 1099 because you don't have to issue a 1099 to corporations.
Great. Thank you, John. And then we have just a few minutes left. And Ron, you're the last one. Go ahead.
Hey, John. Hey, Luis.
Oh, there he is.
All right. I have a question. It's similar to Jerry's.
Okay.
I'm the owner of Ronald's Auto Body. That's a automotive collision repair center.
Mm-hmm.
And my question is, what's the proper way to pay myself? Currently I'm paying myself a portion on payroll and another portion on 1099. What would you recommend, and what's the proper way?
Yeah, you don't use the 1099. So you do need to pay yourself on payroll, and that means you're going to you're going to use a payroll service like us, or don't use ADP or Paychex. I think they're garbage, but I would use Gusto or somebody like us or Intuit, and pay yourself a reasonable wage. You'll need some help to determine what a reasonable wage is. Then the rest of your income, which is the profit, because you're going to deduct from your income your wages and everybody else's wages. You're going to deduct that. Then you're going to be left with a profit. You can pay yourself a dividend or a distribution out of the profit. Okay. And as long as you, and typically what I tell people is just write the check to you, deposit it in your account, and in the memo say distribution, and you're fine. You don't have to issue a 1099. In fact, issuing a 1099 and a W-2 really can kind of trigger an audit if you're not careful.
So that portion of the payment, how you pay yourself, all in once at the end of the year, or can you do it monthly, quarterly?
No.
How do you do that?
First year we might have to do that, but the IRS wants you to ratably do it at a minimum quarterly. So, yeah, because they want the money sooner, right? So if your reasonable wage is 60 grand, they don't want you reporting 60 grand in December and then paying the payroll taxes, January 15th, when they should have had the money clear back in at least April. Okay. They want it kind of paid ratably. So at a minimum, and do you have employees, by the way?
Yeah, we do.
You do? Yeah. I just pay yourself with the employees every month, but you're going to want to have quarterly withholding that looks pretty even. If you don't, they know that game, because what people do is they shift the wage into the 12th month so that they can shift the taxes out that far too. And that's not what the IRS wants. They'll penalize you for it. But, candidly, do we do it that way sometimes? Yeah, because we have to. Because somebody comes to us and they haven't paid themselves all year, so we have to do it that way for the first year. And candidly, we've gotten away with it a few times. So, but I would recommend you move into it minimum quarterly, probably just do it monthly where you have employees now.
Okay. Thank you.
Okay. Well, I hope you guys got some value. I'm happy to come back sometime, and happy to, if you want to set up an appointment with my firm, call me. Janet, I got your message, and I'm sorry, I just got back from Maui yesterday, so we'll be in touch with you. But guys, just call us. You can set an appointment with me. I'm pretty slammed for the next month, but I'd love to help any of you that need some help. And Luis, thanks for putting this together, and say hello to Rob.
Yeah, will do. Thank you, John. And for everyone here, definitely reach out to John. I think he put his contact info.
Why don't you put that back up, Malcolm? And then, did you put it in the chat box?
You can see the information there. Reach out to him or reach out to me. I'll get you in contact with John. He's a very great resource. Please make sure you're doing things correctly. And he's the guy. So we use him personally, Rob using him. So, it shows a lot that we're not just saying he's good. We're actually using his services. So please reach out.
And Luis can say that, but I can't. So, all right. Yes, hey, thanks, guys. And I'm probably going to walk out of here, grab lunch, and check that Canadian pass-through entity, by the way, just because I'm curious, because I couldn't recall it while we were talking. Okay, guys.
Okay, thank you, John.
Thanks.
Okay, bye, everyone. Take care.
Yeah.